Welcome to the Roadmap to Currency Riches instrument module on currency options, one of the 5 instruments for investment that we are covering in this course. An option is an instrument that gives you the right to buy something, such as a currency, but not the obligation to buy it. It is an option to buy and is a very good way to lower your risk. To help you further with currency options, I have the great pleasure of working with Barry Nobel, who holds the position of Vice President of the NASDAQ OMX PHLX. At the NASDAQ, Barry manages the options exchange and specifically responsible for education, product marketing, member and customer relationships, and assists in developing the strategy for the option exchange. We are very privileged to have Barry with us today. Welcome, Barry.
Thank you, Bentley. It's great to be here and help our students understand options. I've often been asked, why use currency options? My answer is always the same. It's my favorite way of lowering risk. Some people have a fear of options, as they may have heard something that spooked them or made them think simply it's just too complicated.
That's what I've heard.
We use options because we don't want to have unending exposure in any instrument. In addition, options don't have the same level of requirement to put up as much to initiate a position, especially when there is a considerable investment required. So we have the opportunity to buy what is called a call option.
A call option.
Exactly. Before I go on, let me explain the first 2 items you need to understand, which are call and a put.
Great.
When you buy a call, you're bullish. And when you buy puts, you're bearish. Now, some people may not understand that. When you buy a call, you expect the market to go up. And when you sell a put, you're expecting the market, or hopefully you're hedging yourself for buying insurance in case the market goes down. So you're bullish on the euro, but bearish on the dollar. Rather than buying the spot or the future, which means putting up the margin, you buy or pay for what is called the premium instead. The actual cost of in-the-money part of the option. Remember, this gives you the right, but not the obligation to own the currency sometime in the future. This right is called buying a premium.
A premium.
Now that the euro dollar is trading at 125, 135 is still quite a range away. So let's say you want to buy the euro dollar for 5 months from now. We would say we want to buy the 125 call option for the exact date 5 months from now.
All right.
We would find out that the price for that option, and that would be called the premium. A premium is basically the interchangeable word for price.
Great. Okay, so I pay that premium to buy the right to
buy
own that option.
Exactly,
okay,
the right
great.
to buy it between now and 5 months from now. The main idea here is what is great about options is we know up front what we were paying, or the premium. We know how much our risk is and the right to own the currency pair. If it should go higher at the cost we have specified, unlike a spot or a future purchase where we pay and then have to go day by day in a wide open market and assume wide open market risks. This is what makes options great and why so many people use options, because they know the risk up front.
And that risk is the premium I paid, nothing more. Am I correct?
That's right. You cannot lose more than the premium that you paid.
Great.
Your risk equals your premium invested plus any commissions, and if the euro gets stronger, then we sell the option, we take our profits. If the euro gets weaker, we either sell our option for the price below the premium we paid, or let it expire and we lose the premium, but never anything more than the premium.
Okay.
I believe it's better to know the risk up front. The compromise is that we have a more limited profit potential, but that is something that lets me sleep at night.
So where you're actually making your profit is if so, this case the euro got stronger, I'm selling the option, the premium that I paid, that somebody's buying that, so I'm making my profit there. Am I correct?
Exactly right.
Okay, great.
Many people, I'm going to use another example because many people, the moment I talk about currencies or if I'm talking to some people about trading options on equities, they seem to get lost.
It gets a little confusing because you're where are you actually taking your profit and when are you actually taking your profit? So yeah, another example would be great.
Okay, so let me make it simple. Sit back and just give me a couple of minutes. Okay? There's a house you might think that you want to buy. Or in my case, there's a house in my neighborhood that my daughter
Right.
wants to buy. She sees real estate prices excelling in my neighborhood, but she's going to be getting out of school in 2 years, and my daughter Hannah wants to live in our neighborhood. So what she wants to do is she wants to buy an option on a house that she can buy a house in my neighborhood for $150,000.
Okay.
Okay? She'll spend $5,000 on a call option to call a house in my neighborhood between now and sometime in the future.
Okay.
If houses go and continue to increase or appreciate,
Right.
she still has the right to buy that house between now and sometime in the future for $150,000 for that $5,000 premium.
Yes, I get it.
If housing prices go down in value and depreciate, and they go to $140,000, she will still be able to buy that $140,000 house, but the only thing that she loses is that $5,000 premium that she laid out in the event that housing prices increased.
Okay.
Between now and the exercise or the time that the option expires, she can either exercise it, or she can let it go away worthless, or she can sell it to another person at an exchange, or she can sell it to another person. In the world currency options, she can sell it to another person at the exchange.
Okay, well, that works. I think I'm getting it. But in the case of your daughter, she's actually, if she buys the house, she's going to take possession of it. Where I'm getting a little bit lost is inside of currencies, because you don't actually, from what I understand, you don't actually take possession of the currency. So can you give me a currency option example? Okay.
Currency options, as we have described, give you the same kind of leverage that investors associate with high rolling currency trading.
Okay.
But they do this with strictly limited risk, but it's a little different.
Okay.
Unlike an option on a house, stock, commodity, world currency options do not give you the alternative to take possession of the currency.
Right, which is what I was just saying.
When you're buying currency options, you're doing so as strictly a hedge or a speculation.
All right.
You're betting on whether the currency will rise or fall. For the profit or a hedge, your currency exposure, but you can never settle the option for a foreign currency. Your option settles into US dollars, avoiding the need to take possession of the foreign currency. In doing so, you have avoided having to hold a foreign currency. You've avoided assuming commissions to convert it back into the US dollars.
Okay.
And you're avoiding having to set up an interbank relationship. In other words, it's easier and it's cheaper to have it settled back into US dollars, where any broker-dealer can take your order.
Okay, but most likely you're going to want to sell that option before. So if the euro went up in our example to 135, and I bought it at 125 and I paid a premium and it hits 135, I'm going to want to sell that option before it actually expires, because I don't want to take possession of the actual, even the dollars.
Well, they'll settle in US dollars just the same as, I don't want to confuse the audience, but as sector index option settles into US dollars.
Okay.
If they want to wait until expiration, US dollars will come into their account, and just the difference of what the option is worth and what the underlying is worth in the strike price will come into your account. You can hold them to expiration. It's a very simple expiration, or you can sell them beforehand. But you're not going to have, in some cases, $1.5 million yen delivered to your account.
Okay, yeah, I definitely don't want that. Okay, so that makes more sense. So what other thoughts you have?
Well, investors like, because a small investment can control a relatively large amount of currency.
Okay.
But your risk is limited to the price you pay for the option, as I said before, or the premium. You're limited to the price you pay for the premium and any brokerage commissions. You really need to talk to your broker about the commissions. They're different in anyone that you trade with. Currency options are very easy to understand and trade. In fact, they work just like options on indexes, as I said before. They can be bought and sold in your regular brokerage account.
Okay, that's great. So what kind of returns can I really expect from a currency option?
Currency options provide a triple-digit return potential, and because they use leverage. This is really a revolutionary investment vehicle for currencies. It gives you huge leverage and gives you strictly controllable risk, which is very important for the currency markets.
Okay.
Currency options are now available from almost every broker in the country, whether they're a full-service broker or online broker. They're extremely popular, they're very liquid, and very convenient to the average investor.
That's important.
Currency options are offered by the PHLX or NASDAQ OMX PHLX, and we have currency options on most major currency reserves.
Great. I covered the basics of currency options in the introduction, but it is always good to hear another perspective or viewpoint on that.
It sounds like a good idea. Options are often misunderstood, and a lot of people are afraid of them. Put simply, no pun intended, an option is a contract to buy or sell an options financial product, officially known as the options underlying instrument or underlying interest. Options come in two varieties, calls and puts. Calls increase in value when the underlying security is going up, and they decrease in value when the underlying security goes down in price. Puts increase in value when the underlying security is going down and decrease in value when it's going up. So depending on what you anticipate happening in the market, you can buy a call or a put and profit from the movement. Let me give you an example, because I gave you an example before, so again, sit back and just bear with me. My dear grandmother, she's 90 years old. I love her to death. She lives in a neighborhood not very far from my house, in a neighborhood that's going through transition and it's going down in value. She does not want to move, and I don't want to force her to move. But I don't believe housing stock in that neighborhood is going to get any better. So what I do is I buy a put, an insurance policy, and let's just say I pay $5,000 for that put.
Okay.
And today her house is worth $150,000.
All right.
And I buy a 10-year put. I can't do that, but let's say I just do it. I buy a put that's going to expire in 10 years. And I have the right to put her house out to a broker for $150,000. My grandmother, time goes on, and houses in her neighborhood are now worth $50,000.
So a big drop.
Big drop.
Okay.
But I own that insurance policy. I have the right to sell it to someone who assumed the risk on the other side for $150,000. I hedged myself against a downside market.
You sure did.
Okay? So people really get confused of what a put is, but that's just a very simple way of understanding it. It's an insurance policy that you tend to buy in case something happens. Bentley, I think many of the students, and I think even you, own puts you may not be aware of.
Really?
Let me give you an example.
Great.
Do you own life insurance?
Yes, I do.
Okay. It's a put. Do you own health insurance?
Yes, I do.
It's a put. Do you want anything bad to happen to you today?
No.
No. You don't really want your put to come into
I
money.
didn't buy the life insurance because I want something bad happen to me. But you're right. No, I
You're
don't.
living. Yeah.
I bought it as a basically a hedge. I
Right,
guess.
it's a hedge.
Yeah.
So
Okay.
think of a put as like that. Health insurance is much the same way. We all have, and we're all willing to pay premium to hedge ourselves, and in this case, it's our life.
Right.
So think of puts that way. It's a very simple way of looking at what a put
That's
call
interesting.
is.
So all right. So now I get that concept. So could you give me some examples of how things fluctuate, and what kind of criteria I should be looking for?
Yes. The puts and calls are made up of different criteria that go in, and putting them together, they make up the value of the put. First, you have time value. Expiration, more time equals high premium, vice versa.
Okay.
Second, you have intrinsic value
Right.
in the money. In the money, it's with the intrinsic value is how much in the money the option is. If there's no intrinsic value, you only have time value.
Okay.
It's the relative price of the underlying asset to the strike price.
Okay. Barry, before we move on, I want to interrupt you for a moment. Could you explain in the money and out of the money? I know we've covered it already, but it's good to go back and review.
Yes, actually, it's a very good question, Bentley. Let's go back to the example, the euro dollar before at 125.
Okay.
125 is the underlying price in the example.
Okay.
If you buy a 125 call, okay, everything on that strike of 125 call is going to be at the money. It's an at the money call if the 125 is at the money.
Okay, so it's right at the money.
It's at the money. Any premium you pay is going to be just time premium.
It's a premium.
Okay?
Okay.
If you buy the 130 call, it's also time premium.
Okay.
If you buy the 125 call, there's intrinsic value of 5 and whatever premium is associated with that. So if you pay $7 for the 120 call, it's $5 in the money. So there's $5 of intrinsic value and $2 of time value.
Okay.
So the option has intrinsic value, which is how much it is in the money, and time value.
Okay, so in the money is obviously when I'm advanced, I'm above at the money. At the money would be even, and I'm above, I'm in the money. Am I correct?
Correct.
And if I'm below what was at the money, I'm out of the money.
Out of the money.
Okay, so
So
in the money,
you're
out
in
of
the
It's
money,
actually pretty easy when you think
In the
about
money,
it. Yeah.
at the money, out of the money.
Okay, so I'm
more-
usually out of money. That's my problem.
And that is, we can remedy that. I can remedy that. Now this
So
is the really
when I start trading options, I better be in the money, but that's okay.
I can start singing, but I am tone deaf.
Absolutely.
Now this is really important.
Okay.
Because if you have, now time value, remember we were talking about time value.
Yeah, time
If
value
it's-
is that period of time that I bought the option for, whether it's 6 months, a year, 2 years, 5 years, whatever it is.
The longer the time value goes out, the more
Yeah.
uncertainty there is
Right.
if that option is going to end out in
Does
the
that
money.
make the premium go up or the premium stay
It
level?
goes up.
It goes up.
The
so-
more uncertainty, there's a higher percentage that money that option will end out in the money. So there's going to be a higher time value. So you'll price an option differently
Okay.
if it has 3 months to go, as it
Great.
does 6 months to go, as it does 9 months.
Great. Are there any other things criteria I should be watching for?
I think that I'm going to give you a little secret that you
Okay.
can use, but I don't want it to be gospel.
Okay.
If you're talking and trading an at the money option,
Okay.
at the money option, a 125 strike, euro dollar,
All right.
and that option is going to have something called a delta, the chance that it's going to be in the money or the chance that it's going to end out of the money.
Okay.
If it's a strike price at the money, it's a delta of 50 because there's a 50% chance that it's going to end out in the money or out of the money.
Okay.
As it goes farther into the money, it'll go to a 60 delta or a 70% chance
really?
that it goes and ends out in the money at expiration. So that's just another way of looking at options.
Okay. All right.
Bentley, before we move on, I have one last
Okay,
thought.
all right.
I wanted to talk about volatility because volatility affects the price of options as
Yeah,
well.
absolutely, I would imagine.
So let's not talk about volatility. Get that word, strike it out of your mind. Let's look at and say uncertainty.
Okay.
Okay, we're talking about volatility, but the more uncertainty there is, the higher volatility there's going to be. So the more uncertainty there is in world events or currencies or what people guess that the central bank interaction is going to be,
Yeah.
the more uncertainty there is, the more volatility there is.
Okay, well, what does that translate into premium
More
value?
volatility, the more uncertainty there is, higher premium. So you can
Okay.
take advantage sometimes of if volatility or uncertainty gets to be so high, you may want to sell the volatility. I'm not saying that that's something that you want
So
to
this
do.
is another area you can make money with options. If volatility changes and starts to go up, the premium value goes up of what you might own already.
That's right.
You can actually then sell that premium, make money on that premium.
Exactly right. So
Great. That's a
and
great way.
if you look at it and you look at the charts that your brokers will give you, and you look at the charts, you'll see that the volatility will move and it'll spike.
So there's all these different factors that make the value of the premium change and go up. So it's a different way of trading. You could see you could see why it's confusing to people, but you can also see the huge value because you're limiting your risk, but you have all these opportunities to profit from this.
And it does. And all of these criteria make up the price of the option.
Superb. Thank you very much. Let's go ahead and move on. We keep mentioning that there's limited risk, and we have all these great potentials for profit. Could you kind of explain why are options such limited risk again for me?
Well, it's very clear that you can only lose what the premium of the option is. And you leverage, you control more currencies than you'd ordinarily buy. Each currency unit controls up to 10,000 units
Right.
of the foreign currency. So it will limit your risk and give you leverage for profitability.
Okay.
A buyer has all the rights, as losses is limited to the cost of the premium plus commissions.
Okay.
A seller has all the obligations and virtually unlimited risk. Next, you have the power of leverage. You can be controlling a huge basket of underlying currency with a small investment. Let me give you an example. A $500 euro call on the PHLX has a 125 to 1 leverage. So a small move in the underlying currency equates to a big move in the premium.
All right.
Three things can happen to us, buyers of calls and puts. We can profit, you can take a loss and capture some premium, or we can lose our entire premium. There are also other key benefits of options.
Okay.
Flexible pricing. There are lots of choices, strikes and expirations. Affordability. Less stress. I like saying that one.
I like less stress. It's good.
Disciplined trading approach. Automatically, strategies and opportunities limited only by your imagination.
Okay. Let's discuss some investment strategies.
Sure. Pure directional bets with puts and calls that we will use currency options include playing the sweet spot of a trend, top or bottom picking, long shots, big volatility moves, like buying lotto tickets.
Yeah, it was what we talked earlier about volatility. Okay.
Event trades,
Okay.
and synthetic cross rate trades.
Okay. So let's talk about playing the sweet spot of a trend. That sounds like something I would be interested in.
It's when you buy slightly out of the money euro puts, expecting the existing downtrend to carry for weeks or for months.
Okay.
The key is looking for a few days of a counter trend move to enter the trade. Example, the Eurozone economy powering higher or housing bites into the U.S. consumer.
Okay.
Buying slightly out of the money euro calls, expecting the euro to continue its uptrend based on the fundamentals. Nothing cute here. You have a defined solid rationales, and you want to hop on board looking to hold for several weeks or several months.
Okay.
Bottom picking,
All right.
something that many people like to do, or top picking,
Yes.
and it's fundamental disconnect.
Why is that?
Well, buying out of the money call or put, you're buying time, and you let the market awake to the fundamentals. And because you're buying against the prevailing trend, you should be able to get the option on the cheap, relatively on the cheap.
Okay.
How far out? It depends. You must make sense of the relative basis, past volatility. Example, the metals and gold markets have clearly peaked. Global growth is waning. China's demand is slowing, but the Aussie dollar continues to rally.
Okay.
Okay, just an example of what you might want to do. Buying an out-of-the-money Australian dollar put, you're looking for some sign of declaration. You don't want to jump in front of a moving train just because you think it's the time.
Okay.
An event trade, short-term holding period, you buy an at-the-money call or put. You're expecting a strong surprise and a big move quickly.
Okay.
An example of that is U.S. non-farm payroll. You expect a positive surprise.
So it sounds to me like there are these different strategies that different types of traders probably like to jump on. I could see somebody wanting to follow a trend, see something out of the money, maybe able to get something lower. They've done some research on the country that they're looking at, and maybe there could be a big win. I imagine that happens quite often.
It does. I think that some people, you're buying an at-the-money euro put. You're expecting the dollar to rocket sharply higher against the key currency.
Right.
If it does, you harness the leverage of an option with very little capital investment. If you're wrong, by buying at the money, you can sell it back right away and still salvage a decent amount of premium.
Great, great.
Let's look at the lotto ticket trade.
The lotto ticket trade.
Yes.
Okay.
You're buying a deep out of the money call or put.
Okay, so I'm way out. Okay.
Out of the money. And you're expecting a very unusual move, a big spike in volatility where there hasn't been before.
Okay.
Because the probability is low and because these options are deep out of the money, they're very cheap. It's a lotto ticket.
It's kind of like the long shot, buying at a horse race or something, the long shot. It's very
20 to
unlikely
1,
to happen,
30
but if
to
it
1.
does, oh boy, do you make returns on that.
Exactly right. Let me give you an example of this.
Great.
You may have a massive unwinding of the yen carry trade.
Okay.
You buy deep out of the money Japanese yen calls,
Okay.
and we'll see what happens. The synthetic cross trade,
Okay.
you're buying a put on one currency and a call on another. You identify a change in market dynamics that suggests the previous relationship between the two currencies is about to change.
Okay.
It's a great setup for a synthetic cross trade.
So you're actually cross trading. Okay.
between two
And why do you do
currencies.
that?
The market changes such that fundamental currencies such as the yen, the Swiss, they look vulnerable to a rally. You buy Swiss franc calls or the Australian dollar puts.
Okay.
You're expecting the Swiss to rally against the dollar, but you expect it to soar against the Aussie because money is leaving the high-yielding Aussie to close the short Swiss franc position.
Interesting.
You buy back, it's a buyback of the funding currency.
Okay. Okay. I've heard of something called the global macro approach. Can you explain what that is and how could we use it?
Yes, good question again. The global macro approach is a top-down approach that is comparable to scanning the headlines.
Okay.
You need to be able to identify global money flow and themes so you can ride the sweet spot of the trend or position for a change in the trend.
That sounds like little bit of research goes along with it. Could you expand a little bit on that? Why is it important to monitor and understand the major global macro themes?
Sure.
Okay.
I'll allow you to better understand the interrelationship between the various asset classes,
Okay.
stocks, bonds, commodities, and currencies. You will know what asset classes are hot, cold, risky, etc.
Yep.
You'll begin to see regional and country-specific opportunities. This will guide you naturally to the best potential
Okay.
and best macro ideas.
All right.
Always start with a broad view, then drill down. The global macro approach is an automatic filtering process. Bottom line is the global macro gives you the ability to develop solid thematic relationships independently from what you can build scenarios, themes, and scripts.
Okay.
Global macro is not hard. You simply scan, read, and think. You scan the following every morning. Key news sections in the Wall Street Journal, Bloomberg, Yahoo International News, Reuters, API. These are all available to you.
Okay. Yeah. Then most of them are free too.
Exactly. Read the following every day. Read about the credit market section on the Wall Street Journal. Bloomberg.com, columnist Morgan Stanley, Global Economic Review. Read the following every week. The Economist, Barron's magazines.
Okay. So I'm going to spend a lot of time analyzing and reading and capturing it. What now?
Well, it's important that you don't become, you can't be paralyzed or paralysis of analysis.
Oh yeah, it could happen.
You don't want to watch too much TV. You don't want to, I'm saying that you're reading a lot, but don't read too much.
Don't overdo it. Okay.
Exactly.
Yeah,
Don't
okay.
overdo it.
All right.
And this will help you develop a fantastic and a realistic market-focused framework that you can apply, which will help you succeed in the currency markets in any economic environment and cross all time frames. I should point out that the global macro approach is not limited to options.
Mm-hmm.
It makes good sense in any currency instruments you're using.
Yeah.
It works in futures.
Yep. Yep. I could see that, and we'll do more of that in the other modules on those topics. Can you help me summarize a little here by sharing your trading philosophy with our viewers?
Sure. My trading philosophy. Let me think about that. You need to gain confidence,
Right.
but not overconfidence. Not an easy balance to achieve. Trade within your risk tolerance, comfort zone, and not anyone else's.
Okay.
You make the final call on the trade.
All right.
Remember that no trade works 100% of the time. Part of the plan needs to be having an idea of what to do and what can go wrong.
Okay.
Currency prices tend to trend. However, prices may unexpectedly and quickly move in different directions.
All right.
Stuff happens, and be prepared to deal with it.
Happens all the time.
As you gain experience and confidence with currency options, look to take advantage of it.
Okay.
Never attempt to trade a currency option strategy that you do not understand. You need to consider the following. Does it fit my forecast?
All right.
What is the risk and what is the reward? What can I do if it doesn't work out and my idea blows a tire?
Yeah.
Just because your broker approved you to trade in a certain level, it doesn't mean you have to, now or ever.
That's very good advice right there, because it's very easy to get leverage in this market, and you could find yourself in a real jam, I would imagine. Now with options, you won't be in that situation.
It Not in that situation, but you will have the opportunity to you'll have the opportunity to get into trouble other ways.
I guess you could overdo it there too. Yeah. Okay.
Approval gives you flexibility as you gain confidence. The goal is to let the profits run and to cut the losses short.
Okay. Okay. These are all good pieces of advice.
Understanding the concepts involved in options pricing helps develop a realistic expectation of what could happen. If managing trades that move against you is as important as managing the good ones,
okay,
develop a currency options trading plan. Let's recap. Okay. Trade with confidence, but be cautious about overconfidence. Understand the underlying market in which you are trading.
Okay.
Understand the mechanics of currency options,
which we went over in detail.
Creating the trading plan will be a cumulative effort of options knowledge,
okay,
risk-reward tolerance, realistic expectations, active trade management, and never trade outside of your comfort zone. And remember, stuff happens.
Thank you, Barry. This was really great. Here are my primary guiding beliefs that I feel everyone should have. First, I absolutely must know my risk. There will always be unforeseen events lingering in the market and everything you do in life. Second, ground your approach in human nature. Price movement in currency markets is sentiment driven by fearful and greedy participants who sometimes approach this irrationally, but they never quite get there. Here are some guidelines. There is no such thing as a market equilibrium. Prices move in self-reinforcing trends with various time frames. The greater the confusion, the more price-led players become. Fundamentals influence prices, and the prices influence the fundamentals.
That's really good.
Yeah. Focus on risk first, and then return second, and predefine risk before taking a position. So try to predefine what you think that is. Currency analysis is analogous to being a judge at an ugly contest. The least ugly wins. Trading is probably bet, and winning over time comes from applying your edge consistently. And every moment in the market is unique. And here are keys to success. Develop an edge that gives you confidence. Apply your edge consistently. Define your risk before every trade and be aware of what's going on in the market. In summary, when you buy currency options, you can lose the entire amount you invest in the premium for that option, plus any commissions you may pay to your broker. But just like with the purchase of a stock option, you can never lose a penny more. There's where you break your risk. So if you invest in them strictly with your risk capital and you don't spend much money on each, then your keep safe money can never be adversely affected. If having money at risk will keep you awake at nights, you probably want to focus on investments with lower risk and lower profit potential. Also, currency options aren't for all your money. At a time like this, the prudent thing to do is to keep your majority of your money safe and diversified. But if you've done that and you have some risk capital to leverage this big trend in this whole new area with investments that could multiply your money many times over, we think this is one of the best vehicles of all. Options involve risks and are not suitable for everyone. Prior to buying or selling options, an investor must receive a copy of the characteristics and risks of standardized options. Copies may be obtained by contacting your broker or the Options Industry Council. Good luck. This concludes our module on options, and I hope you've enjoyed this module. It's been great to be here with you. Barry, thank you for all of your insights and your wisdom. It's really great to have somebody of your caliber on this program, and I look forward to working with you in the future.
Thank you, Bentley. It's been a real pleasure being here today.